Got it, Al-Rifi? Alright, so 4 questions. Number 1, why the dollar price is going up against gold, oil, euro and pound, while the US economy is going down, right? It's actually a very good question, because what is going on right now is baffling a lot of economists. They're puzzled. It is not normal. It should not have happened, but this is what it is, and we have to explain it. And the explanation is called, first and foremost, deleveraging. Leveraging. What has been going on for the last 2 months, especially since Lehman Brothers went bankrupt, has been phenomenal level of deleveraging. So what is deleveraging? Well, you have to first understand what is leverage. Leveraging is the process of all institutions simultaneously. This includes investments, investment funds, possibly mutual funds, possibly, well, certainly hedge funds, certainly individuals, maybe corporations, taking on more debt to do what they do, including taking on more debt to invest. In other words, we call these leveraged bets. So leveraging is the process of acquiring debt and using it to invest with it. Alright? So, you invest with borrowed money is the process of leveraging. Leveraging, especially on a macro level, meaning for the economy, always results in rising asset prices. Well, you have to understand that leveraging in debt, here's another key component you have to understand, that debt is part of, effectively, money supply. So, increasing debt and credit is inflationary. So, what you have to understand is that leveraging is a natural way to cause or to create inflation, and leveraging itself is inflationary. Now, when you get inflation, you have to understand that inflation is the increase in money and credit in the economy. Money and credit. Now, debt is the same as credit. So, leveraging is the use of credit to invest. So, you have inflation. Where does inflation go? In other words, the economy creates money, meaning printing banknotes, and it also creates credit. Credit enters a number of things. In other words, it enters the economy in different ways. Where does the inflation go? The new money and credit go?
The high price.
Yes, in high prices, but the question is in what? What things?
Products.
Okay, products, and we call this, well, it has a special name. Call it consumer inflation. So, it, results in higher consumer prices, and we properly call it consumer inflation, and it is also known as price inflation, because this is the inflation that hurts the consumers the most in a very direct manner every single day. Now, the second type is called asset inflation. Asset inflation. These are assets in which we invest. These assets are stocks, bonds, real estate, and other investment classes. Could be possibly foreign currencies, okay? So, asset investments usually means that inflation results in booming real estate and booming stock prices. You see booming real estate and economy, see booming stock prices, meaning rapidly rising well above normal historical trends. you know it's inflation. Now, here is part of Wall Street language. They don't really call it inflation. They call it a bull market. But a bull market, especially synchronized in both real estate, stocks, and bonds, because rising bonds mean lower bond yields, mean lower interest rates. So lower interest rates drive at the same time higher stock prices, and at the same time higher real estate, is inflation. It is an effect of inflation, all right? So, inflation results in booming, rising, or bull markets in assets. Stock and real estate are usually the typical one. There is a third place where inflation can actually show up. It shows up in trade deficits. Like suddenly the economy is creating a lot of monies, and you all begin to drive BMWs, right? Or Porsches or whatever, you know. So suddenly, when people get a lot more cash, they can spend it on local consumer goods, but they can also spend it on imports. So they show up in booming imports. So that's trade deficits, booming imports, all right? And the last one is the most innocuous. We call it cash balances. In other words, people don't keep 5,000 real in the bank, they keep 15, all right? They have so much money that it's no big deal whether you keep 5 or 15. You have 1 million, no big deal, right? So, cash balances. All right, so why this whole thing, to answer your question? Inflation is the process of leveraging. And leveraging first and foremost in bull markets always shows up in the asset, as an asset inflation, booming stock market. Then it shows up as booming imports, and only last it shows up as consumer price inflation. When you have assets booming but not consumer inflation, you're in the early stages of inflation. It can last 2, 3, 4, 5, 6 years. Then when you get consumer inflation, you are the late stages of inflation. It can last 4, 5, 8 years, possibly 10 years. The US, the early stages of inflation were the 1960s, all represented the early stage of inflation. And then consumer price inflation kicked in, I don't know, maybe 68, 70, and it went on for 10, 12 years, all the way to 80, 82. Maybe even throughout the 80s, there has been lingering price inflation, so for another 10 years. Back to your question. Inflation in credit drives asset prices on the way up, and when, usually as a result of shaken confidence in the monetary financial system, or as a result of restrictive monetary policy by the central bank. In other words, there may be different triggers, but the effective result is deleveraging. Deleveraging is, or means, the process of attempting to sell as many assets as possible, usually sell the most liquid asset. In the process of selling the liquid assets, you take the liquidity, meaning the cash, and what do you do with it? Pay down the debt. Pay down the debt. In other words, when leveraging is inflationary, it turns out that deleveraging is deflationary. Deflationary. Alright, so the basic lesson learned from US history, of course you can use Japanese and other histories, is that deflationary is totally deadly for the banking system. It also results in a lot of high unemployment and other problems and whatnot. But one thing, that one ill or evil which deflation does not result, is higher consumer prices. Consumer prices in a deflation fall, so at least those that work and have some money can benefit from deflation, and those who have worked, have saved honestly, can benefit from deflation. Okay? So, currently, since Lehman Brothers bankruptcy, there has been total loss of confidence in the US financial system. This is known, and you will hear about it, at least in English. The term is called counterparty risk. Suddenly, you can no longer trust the other side. Now, what does it mean you cannot trust the other side? Well, this is the same as confidence is shaken, okay? Or confidence is undermining. So, confidence means you trust the other guy. Well, if you cannot trust the, you don't sufficiently trust the other guy, now why you don't trust him? What is it? You consider him risky. The other guy we call counterparty in finance, all right? Well, the other guy could be the other financial institution, the other hedge fund, the other mutual fund, the other whatever institution, the other side which uses your money. All right, so at this point, there has been a deflationary spell. Spell is a period of time for which deflation grips the economy. It grips the economy because everyone is afraid of counterparty risk and everyone has to sell assets. Now, part of the deleveraging is forcing it, meaning accelerating the process, so-called margin calls. An example will be someone in the futures market. Someone in the futures market bought oil at $100, some hedge fund, oil price went down to 90. They are having a margin call because they leveraged 10 to 1, their equity was wiped out, and they must post some margin, in other words, recover the 10. Well, they don't have the 10, they must sell. You have a whole bunch of hedge funds and other investors and anyone in the futures market which are forced to sell because they must meet a margin call, but they don't have the equity to post a margin call, so they're sold out. We call it liquidated, and when they're sold out, this drives the price down. But what? Price from 90 is driven to 80. Now there's a whole new wave of people who are facing a new margin call. In other words, a margin call results in a wave of selling, and the wave of selling results in a lower price, and the lower price results in a new wave of margin calls, and the new margin calls results in you're having a vicious spiral to the bottom. When the bottom hits, what then?
Recession.
I don't know. When the bottom hits, the price springs back like you've never seen in a while. So usually after forceful liquidations as a result of margin calls, the price almost always overshoots because it becomes self-feeding on itself. And here's the next big thing to understand. Almost always in a massive deleveraging, at least in the futures markets, you always get so much selling to the point of completely having oversold the commodity. In other words, those that sold at 60 or 50 sold because they were forced to do, because they had no choice to do, and if they could, they would not have sold in the first place because they believe the value is much higher. But guess what? Once the selling is over, and we could be talking here 2 days or 2 weeks or 2 months, usually investors know and realize what would be the market value of the commodity respectively. The buying comes in, and from 50 it could drive the price to 70 or 80 in a matter of 2, 3, 5 days. This is exactly what happened in early January 2007. I don't know how well we remember that time when oil was like $90 before that. Suddenly, warm weather in the US, a few other things going on. Goldman Sachs manipulated the oil market. How did they manipulate the oil market? Well, they have a commodity index. And you have some wheat, some oil, some copper, some gold, and whatnot. You want to manipulate oil? Very easy. You lower the share of oil in the commodity index. What happens? Everyone who imitates the commodity index must sell oil. So they lower the index in half. Everyone who's holding oil, as part of the commodity index, because they imitate the whole index, the result, of course, is everyone is selling. They gotta sell half. They sell half. And it becomes the feeding frenzy on the way down. It's a vicious circle. It's actually a hell for those who are long in the position, because the price goes down, they gotta meet, they're in trouble, they're losing more, they gotta sell, and this whole thing goes down. So what happened was, from 90, the price collapsed down to 50. But it stayed there for barely a couple of days. Then it recovered to 60, to 70, to 80 and whatnot. And you should know, in 2007, it was back to $99 on Christmas of 2007, right? Well, here is the other example. Let's explain that it works both ways, not only this way. So, there were some funds that then bet, oh, oil is so terribly expensive at 100. Now, true or false, I don't analyze. They believe so. So they start putting shorts. They sell on the market, someone else buys. They sell on the market, someone else buys. At some point, what happens? The oil price goes to 110, and these guys get squeezed. In other words, they get a margin call, they're short, they sold at 100, the price of oil is 110. What's happening now? They sold short, they gotta buy. They buy, they drive the price to 125 and 30. What happens next? A whole new wave of margin calls on everyone who sold short. So suddenly, it goes to 135. It triggers yet another wave of margin calls. Suddenly, it goes to 145. Literally $10 in one day. Alright? So, this is where all the shorts that sold short and can't handle the margin were ultimately liquidated. And then, because it was a wave of, or a frenzy of short covering, we call it short covering rally, it was parabolic on the way up. What do you expect next? You expect that as soon as the short covering rally is over, the prices collapses from the artificially short-term high price. So from 140, it starts going on the way down. Alright? So, back to this. Deleveraging actually has been throughout the whole market. This includes also the stock market. In other words, they had to sell stocks if they could. They drove the prices of stocks down. They would sell oil. Why? Because oil is the most liquid commodity. If you have oil, oil is the easiest to sell. You know you can sell 1 million barrels like that, and it's not going to affect the price much today. Alright? Then they say gold, wheat, and everything else. So the process of deleveraging has caught at the same time the stock market and at the same time the commodity market. And they sell, due to the overall deleveraging, everything. So, who are they? Right? You have a lot of speculative investors, but you also have a lot of hedge funds. So these hedge funds entered the game too late. Hedge funds entered the game at 20, 30, 40, 50, 60, 70. As the price goes higher and higher, you get more and more, it attracts more and more hedge funds. So suddenly, it turns out that from 100 to 140, it attracted so many hedge funds. I mean, more than what it attracted from 20 to 100. So that all of these getting liquidated push artificially low the price of oil all the way down to 70. So the deleveraging process means that there is an excess supply of stocks, and therefore their price falls. There is an excess supply of every commodity, every tradable commodity and liquid commodity, so excess supply of commodities, and because everyone is paying down debt. In other words, you have a margin call. What does mean margin call? Give me cash. Well, give me cash means that demand for money goes up. So, and when we say money, we definitely mean cash. And most of these have borrowed in dollars. So when they borrowed in dollars, suddenly demand for dollars increases.
And they don't have any liquidity.
There is no liquidity. Well, whether they have it or not, doesn't matter. Demand for dollars has gone up. But at the same time, dollars are traded for commodities and traded for stocks. The supply of commodities and supply of stocks goes up. So demand for the one goes up, the supply for the others go down. You will have the ratio of the two, meaning the value of the dollar rising against the others. So this is exactly what is going on. And currently, margin calls and deleveraging has stronger effect on, and here's the key, short-term prices, short-term value of the dollar, and respectively dollar prices for oil, gold, and everything else, stocks. And therefore, the short-term outweighs currently, at least for the month of October, possibly September and October, outweighs the overall weakness of the US macroeconomy. So, the overall weakness will certainly reassert itself and will show that it's more powerful. But the long-term weaknesses are always more powerful, but they never or not always affect short-term. They always affect long-term. And that's why we call them long-term. They are long-term because day-to-day or week-to-week they may not dominate. But usually 3 months, 6 months, or a year down the road, they always dominate the markets. Is this clear enough? All right. Any questions on my current explanation? Any questions? Is it clear? No questions?
Yeah, I just have
All right.
one clarification.
Okay, that's what I mean.
Margin call, it means we need money, we need cash.
Yes, we need from you money. So the way
So we're shorting cash.
the way it works is you said I'm buying oil at $100 and I'm posting $10 margin. In other words, you bought 1 barrel for 100, but you didn't pay 100. You paid only 10. And the margin is like guarantee. You guarantee that you will make the purchase, right? And what happens is if oil goes down to 95, your margin goes down only to 5 because you lost already 5 of your 10, okay? If oil goes to 90, what you have secured the deal is 0. So when the price goes about 95, your broker will says, come up with an extra 5 to recover the 10. In other words, no matter what the price is, you must maintain at least $5 of margin. And we call this maintenance margin. The $10 is called initial margin. So if you want to buy to initiate a position, you must put in 10. When it goes down to 5, you must restore the initial margin. Well, this is when the margin issues the broker issues a margin call. Margin call means you must restore your current margin to the initial level. Your current is 5. You must bring in cash or other liquid assets because a margin call could be met with government bonds. But of course, if the price goes down, the broker will sell your government bonds and take the cash, right, to satisfy the margin. And then have to post more. So sometimes it's called to post margin, meaning to send money to the broker to satisfy a margin call. All right? So this is what it is. And when the price goes down, again, the same old story. Of course, if they had more money and if they had more cash, because they're speculators by nature, they would have used that extra cash to buy bigger positions. Instead of buying 1 million barrels, they would have bought 2 million barrels. Or ounces, 1 million ounces of gold, they would have bought 2 million ounces of gold. So the result is these guys typically don't have cash because whatever they have, they already use to speculate. So when the price goes against them, because they don't have the cash, there's nothing left but to sell and liquidate. All right? So that's the explanation. Short, well, not that short, but fairly accurate at the current point. Deleveraging does not in any way represent long-term trends, and because it's forceful, it happens over the last 2 or 3 weeks, and essentially the financial markets are spinning out of control, they certainly dominate the long-term weakness of the dollar. More questions?
So the deleveraging is the cost of the prices of dollar going up, and it's just a short-term thing.
Yes, so deleveraging is, we say demand for dollars go up, and is always a short-term thing, yes. Now, the leveraging process, on the other hand, could be a very long-term. You could get a 5, 10, even 15 years of leveraging. Of course, it will not be always a straight line, all right? Same thing with deleveraging. You can have a wave of deleveraging for 2, 3, 4 weeks, then things stabilize, everything's okay, but the fundamentals reassert themselves in 3, 5, 6 months. You begin another massive wave of deleveraging. This is exactly what happened during the Great Depression. And if the stock market is any indicator of leverage or deleveraging, what really happened back then is exactly like this. It's called waterfall. Stock market has been going up, 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 up all the way from 1921 to 1929 and peaked somewhere in 1929, and there was wham! Big collapse in the stock market in a matter of weeks. And then everything was fine and everything was back to normal for 4, 5, 6 months. And the stock market recovered, everything was great, and then suddenly something happened. Wham! The stock market collapsed again, literally, in a matter of a week. So everything was fine, and then for another 3, 4, 5 months, and then wham! Again, a third. So we call this a leg down, or waterfall, right? So this is the first leg down, the second leg down, the third leg down, and then again, and then wham! Once again. 7 times in a row, the bottom was reached on the 7th time, on the 7th major leg down. And from roughly, let's say, August to or October of 1929, the leg was down, the 7th leg down was reached approximately, well, let's just say July of 1932. Roughly 4 years, from 29 to 32, roughly 4 years, 3, 4 years. So 7 legs means that 1 leg down on average was roughly 6 months. On the way down it's usually precipitous, and on the way up was fairly slow, meaning fairly lengthy. Some of the rebounds were actually really, really fast, okay? Again, I don't want to get into technical analysis, but again, you get these waves of selling and then the fundamentals reassert. So, if the long-term trend for oil is up, you will get these vicious sell-offs where the price will normally fall 50%, and this is perfectly normal. This is perfectly acceptable. And this is how markets work. And just because the price fell 50%, there's nothing wrong with that. That's perfectly normal. Now, it will be worrisome if it falls very slowly. In other words, it's a relentless fall. When it just collapses, it just means that there has been, now deleveraging is also called another term, unwinding of leverage. In other words, you have a process of leveraging, so suddenly leverage is unwound, in other words, the system deleverages, and then it continues its move according to its long-term trends. So these we call intermediate corrections. This is part of investments technical analysis. Intermediate corrections, or sometimes short-term corrections, are associated with massive leveraging or, respectively, deleveraging that proceed with fast speed. Is this?
Yeah.
All right, hopefully. Anything else before we move on to 2? 2. In class, I said that yen and the Swiss franc are the most stable currencies. Question is why, right? Well, the answer is very simple. The yen and the Swiss franc are the 2 currencies, paper, fiat, government currencies, that have the lowest supply growth. In other words, these are the 2 currencies which their governments print the least. In other words, a currency is stable when there is little printed from it. Little printed from it. And it is unstable when the government prints a lot of it.
Like the dollar.
Like the dollar. Okay, well, turns out that the Russian ruble was very well printed and very fast. You may be, well, you should not be surprised. Another fairly unstable currency is the Saudi Riyal. It is printed at what rate? How much per year? 30%. The official statistic is 29%. Every economist currently believes that this statistic is true, correct. There is no incentive to lie or cheat. So when they tell me 29%, oh yeah, that sounds right. Bulgarian currency has been printed about 31%. Again, very unstable currency, all right? Again, it may be perceived as stable because the Saudi Riyal is fixed to the dollar in a currency exchange rate, a fixed exchange rate. Bulgarian lev is fixed to the euro in a fixed ratio. So it provides a parent. But what fundamentally drives, that's very simple, what fundamentally drives stability of a currency is the speed with which the government creates the new currency, okay? So if the government prints a lot, it is relative. Again, doesn't mean that it's unstable. It is relatively unstable. In other words, the Japanese are printing at 3%, the Saudis are printing at 30%. The Japanese currency is relatively more stable than the Saudi Riyal, even though short term they may be going up or down. Similarly with the Swiss franc. Swiss franc is barely going at 2 or 3%, all right? So essentially, for stable currencies, what you do is simply look up a reference table, like the Economist has one on the back page, which simply shows you money supply growth rates. In other words, how much the money supply is increasing, normalized on an annual percentage basis. And those that grow the least are relatively more stable than those that grow the most. Now, there is something that is very different and doesn't apply specifically to Saudi currency, and to a certain extent doesn't apply to Russian currency. In other words, doesn't apply to resource economies, is that currencies typically should have some sort of backing. Historically, the backing of currencies, paper currencies, has been typically gold. But in modern days, especially since 1971, since the US dollar was no longer backed by gold, oil became that unsaid backing of a currency. Oil became the backing of the US dollar. Again, it's a little bit more complicated, you can read, but what you got to understand is that as long as you have oil, meaning not just Saudi Arabia, any country, or resource, it could be gold, like South Africa, it could be other resources like Australia. So what you will be hearing now very a lot, and perfectly correct, is that those countries that produce resources, we call these resource economies, will have relatively more stable currencies because the currency is backed underneath by the resource. Even though the resource today is in the ground, but tomorrow will be above the ground to actually sell on the international market. So those economies that have, on the other hand, fairly valuable resources which they can sell, the resource itself acts as strengthening, we'll also call it underpinning. And if the value of the resource increases, you can actually increase proportionately more the currency, the quantity of the currency, without destabilizing it. In other words, if the value of oil, I'm just providing as an example, was rising annually at 30%, well, let's say measured in dollar terms, but rarely the dollar is rising at 30%. And at the same time, government is increasing the money supply at 30%. And effectively what's really happening is the currency is backed by the oil underneath. The currency effectively becomes perfectly stable, all right? But the trick is that the value of the oil's got to rise 30% against all other currencies, effectively, all right? So I'm explaining a lot of complicated stuff from international finance. Again, it's fairly complicated. Usually take about, about a month to go into the fundamentals of valuation of currencies, of currency backing, and all of these things. So, in a sense, you want a currency which is printed the least. But on the other hand, you want a currency which is backed by most resources in the ground and the best ability of whether the government or the private sector to extract the resource and bring it on or to the market, and again to the international market, so that it can sell it for other resources or other harder, better currencies. Is this good enough? 3. Can derivatives be considered a part of the problem that caused the economic crisis? And the answer is yes.
Short selling is part of the derivatives?
Okay. Now, let's try to explain.
Can you repeat the question? Can you repeat the
Yes,
question?
I certainly can. Can derivatives be considered a part of the problem that caused the economic crisis? Well, you have to understand, somehow the picture is presented, of course incorrectly, that suddenly things went wrong in March with Bear Stearns, or in August or September with Lehman Brothers, and things just went down. No, it's nothing like this. This is the same as saying, and I use this example in all of my classes, someone who's been drinking for 25 years hard alcohol and suddenly suffers from a liver problem, says, oh, his liver went bad and his health is gone, he's in bad health. Well, we can't just blame the liver for the bad health of the person. You got to blame 20 years of a lot of drinking. Same thing with drug addicts. You have some hard, drugs, people use them for 5-10 years. They totally wipe out your health, and suddenly says, well, he can't sleep anymore and he can't eat anymore, and the cause for his health problems is like he can't sleep and eat. And everybody will tell you, sure, if someone can't sleep and eat, his health is going bad or rapidly, deteriorating. But the answer is, this is too naive. Every common sense person knows that it's not that because he's not eating or sleeping that he's having health problems. It's because he abused for 10 years hard drugs. And they caused, not, the lack of eating or appetite or sleeping. You see, it's the same thing with the recent credit crisis. The real cause is the abuse of credit and the use of credit instruments which provided for excessive leveraging of the whole financial system, which ultimately caused or triggered the liver problem or the loss of appetite. Well, what is the loss of appetite here? Well, the loss of appetite is people don't want to take more credit. Alright? They said, enough is enough. We want to pay down credit. Or, whoever lent money says, no more credit to you, pay back, meaning deleveraging in both cases. In other words, the problem is not the deleveraging. That's very easy to claim. The real problem is years, well over 10 or 15 years of excessive and non-stop leveraging. That's the very root cause of the deleveraging that we're at the very beginning of the leveraging process, right? I mean, you can't just, do drugs for 10 years and go for 2 months rehab and then you're done. If you abuse something for 15 years, it's going to take good 5, 6, 10 years. Japan had their credit binge in the 80s. They started in the late 70s, early 80s. They went all the way to 1990. And from 1990, they have been suffering for the last 18 years from deleveraging and deflation. Alright? The government has tried every time to reflate, meaning to inject more credit into the economy, try to inject more confidence in financial institutions so they can begin borrowing and lending again, right? And they haven't been able for the last 18 or 19 years. In other words, when you get to abuse credit for 15 years, you don't get it fixed for 5 months. It's simple as that. It's also one of the lessons from the Great Depression. The U.S., the global financial system after World War I, began abusing credit from 1921, and 1919 was the end of World War I. So 1920 was the deleveraging or paying down of government debt that governments used to finance the World War I. So from 21 began the new credit binge all the way to 29 for 8 years. And most of the deleveraging occurred from 29 all the way to 32. Usually it takes about, not always, takes about half the time to deleverage. So you leverage for 16 years, it takes about roughly 8 to deleverage. Now, the government can speed up the process or they can slow down the process. Well, the government, US government, as well as, well, just recently what? The United Arab Emirates, they said, oh, we're guaranteeing all bank deposits, correct? They did like last week, right? Oh, this week. No, this week. This week they did, correct. So, all of these things that governments do, they effectively do for one purpose, to stop the process of deleveraging. Because stopping the process of deleveraging stops the pain now. Stopping the process of deleveraging only means that we postpone that deleveraging process for a later time. The Japanese government tried 6, 7, 8 times and successfully stopped the deleveraging process. But it's been going on and continues to go on now in 2008 for the 19th consecutive year. Again, with a little breaks. And
so do you think they shouldn't stop?
I'm not saying I don't think they shouldn't stop. I'm saying it, if you want to get done over quickly, fast, and move on with life, they should not stop it. They should let it go through, because in Japan what you have is called the lost generation. This is the generation that was 20 when the credit crisis, the Japanese credit crisis in 1990 began. And these people lost their young years. Now these people are 35, 38. They have lived their active young lives from 20 to 35 or 25 to 40 in a depression. They had no job growth, no job opportunities, and difficult credit, etc., etc. In other words, this generation has lost most of their prospects. And that will be for, let's say, you guys. I'm not saying it will happen. I'm not saying. But suppose it works out for 15 years. That will be, I would think that it's what you really want for yourselves. Presumably, you're what master students between the age of 22 and 28. These are 90% of what MBA students, well, students are between 25 and 30. You don't want to see for the next 10 or 15 years the economy slowly, global economy, slow, suffering, and no job opportunities, no economic growth, no rise in standards of living, falling real wages, and all the economic ills that, associate this type of depression that Japan has been going through over the last 18 years. Again, do you just want to go through in 2 years and move on and start a new life? Or you want to drag on for 15 or 18 years?
Do you think 2 years is enough?
Well, again, it depends. If the governments really do not stop the process, 2 years will be more than enough. You'll see in the US maybe 3,000 banks go bankrupt. You see a lot of people lose most of their money. Bankers will be out of jobs. The picture will be disastrous. But in 2 years, it could be over. But the alternative is dragging things on for 10 or 15 or 20 years.
And then our children will suffer.
Okay, well, again, I don't want to talk about, sufferance of children. Sometimes, again, wait a minute. It depends on how you define sufferance. Those children in the United States that rose during the Depression, they rose with strong values. They value saving. They value hard work. They understand that there is no easy profit in life. They understand that there is no quick road to riches. They understand that honesty, integrity is what matters. I don't want to get into the social and moral and ethical aspects of depressions. They have other dimensions in economics, just because I don't want to and because that's not what I do. But there are. But the Great Depression, that particular generation grew with values that were radically and radically different from those that were before them. Of course, it took 2 to 3 decades for the lessons to be learned, and then the new inflation and the new credit binge and everything else to begin all over again, that we're repeating it now, so that when the old man, he's 80 years old, says, well, during the Great Depression, say, Grandpa, things are different this time, we got the lesson. All right, so back. Okay, yeah, we forgot. So back to derivatives. Derivatives were instrumental in allowing the leverage process to continue a lot more, a lot longer, and to a much greater degree than without derivatives. So derivatives enhanced or provided, well, most of those derivatives were instruments of leverage. And the latest instruments were leverage on top of leverage. So if an instrument that creates a leverage of 10 to 1, then you use a synthetic derivative which creates a leverage of 10 to 1 on the derivative. So the new derivative has a leverage of 100 to 1, 10 times 10. So what derivatives that contributed to extending the credit binge, prolongating it in time, and the extent in terms of leverage, and the result is that the global and certainly the US financial system is so much more leveraged with derivatives than without. So in a sense, they have exacerbated what would have been a bad situation. Derivatives have contributed to making it a lot worse. Is this good enough for today?
Yeah.
You all happy?
Yes.
All right. Okay, let's turn this off.